There's one thing that we do in trading, in options trading. It's pretty standard across the board. I don't know if many people talk about this though. And so I thought I'd share this with you as a little bit of a bonus for this part of the course. And that is the mid price. All right. Now, savvy buyers, savvy shoppers will always want to get a discount. Savvy shoppers will always want to get a discount. They don't want to pay a full price. And then people who are selling want to get as much money as possible. And so there's a way to do this in your broker platform, and that's called trading at the mid price. So let's go look at trading at the mid price. Hey traders, welcome back to Options 101. Today we're going to take a deeper dive into options pricing here in part 4, where we're going to look at an actual brokerage software platform, look at some real-time pricing, show you where to find everything. Again, this is the 4th part of this 10-part series, and I hope you're enjoying it so far. Make sure you've gone through our disclosures. Everything here is for educational purposes only. Feel free to pause if you need to, but let's dive right in. As a reminder, make sure you take notes. We're going to discuss some options vocabulary today that's specific to options trading. I'm also going to ask you to do a few things, and if you have your own broker platform, you might want to come back and pause, rewind the video, compare it to your own platform if it's different from mine, but you will have the same features available. They just might be in a different location. So again, use the pause and rewind feature, write questions down if you have them. If you have something that's not answered in this or any of the other parts, make sure you email us, help@optiongenius.com. All right, so the first thing we want to do is we want to look for what's called the option chain in your broker software. So broker platforms, trading platforms let you trade the shares of the underlying, but they also have an option chain if options are an available product on a specific underlying. So let's go over to my trading platform here. I'm just going to share my screen. There we go. This particular trading platform is called Thinkorswim. Maybe you've heard of it before, maybe you use it, maybe you don't, but it's by the brokerage TD Ameritrade, and they were bought by Charles Schwab, and that whole merger thing is a different story. But Thinkorswim is a brokerage trading software. It's installed on my computer. Now, brokers do also offer a web-based trading access where you pull up your favorite browser, open a browser tab, and you can log into something that looks similar to this, but it's through a web browser rather than a separate installed piece of software. And then you can also access your brokerage account through a mobile app on a tablet or a cell phone to do your trading there as well. But again, we primarily stick to explaining these concepts on the software installed on a PC. So I'm showing you here on Thinkorswim, whether you have Robinhood or Merrill Lynch, E-Trade, Tasty Trade, whatever it is, they're going to have these same main features that you can look for. So at the end of this, I'm going to be asking you, if you do have some brokerage account, just find the software and get familiar with it. All right, so I'm going to focus here on the trade tab. There are lots of different tabs I could go to, but we're going to look at trade here. And then we're seeing, let's see, I set this is a virtual account. There isn't an actual $100,000 in here. That's a virtual $100,000. And then I set this, as far as you know, today is July 14th. And I picked this date in time in the markets because Apple was trading pretty close to what we've been discussing in this course at about 190 a share. And I wanted to use Apple as our example when we look at the options. So the slides I showed said the first thing we want to do is find the option chain. And on the trade tab, you'll see underlying. Right, we've been talking about how the stock or the ETF is considered the underlying, and then here is our option chain. So I'm going to go ahead and click on option chain, and when you do, you're going to see, or you should at least see, a list of different dates. Right, so what these dates represent is when the option contract is going to expire. And so since July 14th is a Friday, these July 14th of July 2023, these contracts expire today. There are 0 trading days left, 0 days until it expires. Next Friday, the 21st, 7 days, the 28th, 14, 21, and 28, and so on and so forth. So as I mentioned in a previous part, these options expire on Fridays. And then Apple offers the opportunity to have weekly expirations. Some only offer monthly expirations. You'll notice that September, October, November, December. So some only offer those. If they do offer weeklies, it'll say weeklies. But again, that's not what our focus is. Look for the option chain, and the option chain is sorted from the contracts expiring the soonest to those expiring way out in time. In fact, if you look down here, we could buy or sell some options contracts as late as or far out as December 19th of 2025. So, a couple of years from now, that's a lot of time to be sitting on a contract, but each one of them serves their own purpose. They're all useful. So A lot of that's discussed in the strategy courses. All right, so what do we want to do next? Let's go back to our slides. Let's look at what is the next thing on our agenda. Okay, so we found the option chain. We opened the option chain and noticed that it's broken down by expiration dates. And now each expiration date is going to show the individual pricing details. So I'm going to go back over in just a second, and I'm going to click on one of those expiration dates and see all of the different pricing details. I don't want you to get overwhelmed. I'll explain the key components just so you know what to look for. A lot of the stuff can be ignored, at least for now. When you're just learning the basics, you don't need to know everything about what you see in your broker platform. There are just a few key items you should be looking for. So let's go back over to the broker platform, and I'll click on one of the expiration dates. Okay, so here we are back at Thinkorswim. I want to look at, let's go to these options here. These contracts for Apple expire in 14 days on July 28th. And so I'm just going to click on this drop-down menu, and we're going to see some information about the options. And I'll explain what these are in a minute. What we're primarily going to focus on is this strike column down the middle, the fact that calls are on the left and puts are on the right, and then bid and ask. I'll explain what those mean if you don't know already. So let's go back. Let's take a look at our slides. What should we focus on first? All right, so we want to look at strike price. So I pointed out the strike price is in the middle, calls are on the left, puts are on the right. So let's just go confirm that. All right, let's go back to our trading platform. And yes, and this is very standard layout for all trading platforms. The strike price, remember that's the price at which the contract is saying you're going to exchange those shares, is right down the middle of your option chain, right? So $190 a share. There are contracts we could trade for $192.50 per share, $200 per share, $175 a share. So the strike prices are down the middle here, and you have the ability to show a lot of different strike prices. Like if I change it to all, I'm going to get, oh my gosh, so many. So that's a lot. So let's just kind of shrink it down so we can see it all on one screen. Okay, as I mentioned, call options. Call options are on the left side of your screen. Again, that's a pretty standard format. This is where you will see the information about the call options, and pretty standard format is for puts to be on the right. So if you look over here, these are the put options. These are the call options. These are the different strike prices that we are looking at that we could potentially buy or sell some contracts. All right, now let's get to some options-specific vocabulary. I'm going to talk about 3 different terms that we use in options trading quite a bit. ATM versus ITM versus OTM. What do these stand for? ATM stands for at the money. All right, so what does at the money mean? Well, that means that the contract that we're trading is as close as possible to the price at which the underlying is currently trading, at the money contracts. Let's go take a look. I'm going to bounce back and forth. I hope you don't mind. Let's go back over to Thinkorswim. And so we look at Apple. Apple's trading at a little over $190 a share. So if we go to our broker platform, that 190 strike is considered an at the money contract. Right? So the at the money call contracts would be over here, this line item. And if we run over here to the right, the at the money put contract. So $190 is as close as possible to the current trade price. So those contracts, those calls and puts at 190 are considered at the money. All right, the next one we want to talk about is in the money. Let's go back, and maybe I'll just grab the 2 so we don't have to bounce back and forth so much. But we have in the money contracts, ITM, and we have OTM, out of the money contracts. So what do those mean? In the money and out of the money. Let's go take a look. I'll see if I can explain these. Go back to our broker platform here. All right. In the money. We're in the money. Like that old song. In the money means that your option contract has intrinsic value, right? That the price at which your contract has been, the strike price of your contract compared to the trade price of your contract means your contract has value. So for example, if you remember the call contracts we were talking about, we had mentioned trading the 190 strike call contract. Well, let's change that up a little bit. Let's say instead of 190, somebody had bought the $185 strike call contract. You'll notice that all of these contracts that are below, on the call side, below the current trading price are shaded. And that's because all of these contracts are considered to be in the money. They have intrinsic value, right? If I had a call contract that says I could buy 100 shares of Apple at $185, but it's trading at 190, that call contract's got $500 worth of intrinsic value. So that's why it's considered in the money. It's got some intrinsic value to it. Similarly, over here on the put side, the in the money contracts are prices that are above the current trading price. Because if I had a put contract and I could sell Apple shares at 200 a share, well, they're currently trading at 190. That's $10 per share. That contract's worth $1,000, right? I could buy 100 shares at 190 and then use my contract to sell 100 shares at 200. I would make $1,000. So that contract has intrinsic value. It's in the money. All right. So we've talked about at the money, 190, in the money where it has intrinsic value. And now let's talk about out of the money contracts. All right. So in our example, the call contract in our previous example was 190. And we talked about Apple trading up to 195. Well, if you notice, 195 right now is considered out of the money. It doesn't have any highlighting. It's just a standard background here. Same on the put side, below the value that the stock is being traded for. So these are considered out of the money, and here's why. If you were to have bought a $195 call contract, well, that means you could buy shares at $195. Why would you want to do that? Shares are trading at 190. You could just go on the open market and buy them for $5 cheaper. So this contract doesn't have any intrinsic value. All of its value is extrinsic. And I'll show you where to find that information in just a second, right? We have some time before this contract expires, and there is a good chance that this Apple stock, it's been running up lately. They've got great earnings, good company, lots of fans of the product. Maybe in the next 2 weeks, Apple stock will be above $195. So as a speculator, I might want to buy one of these contracts. All right. So we've talked about at the money, 190, in the money, these shaded regions, and out of the money, these non-shaded regions. All right, so the next on the agenda is the bid and ask. Let's go back over to the slides really quick, just to make sure. The bid and the ask price. What are these? Bid and ask. So ask is what the sellers of the contracts are asking you to pay, right? They're asking for so much money. And just like at an auction, if you make a bid on an item at auction, the bid is how much you are offering for that object. So they use the same similar terminology in options trading, and we're going to look at the bid and ask price of these options contracts. So let's go back over to our trading platform, and we're going to look at the bid column and the ask column. So let's go back over. Here we go. Okay, so I want you to take a look up here. If you look at the actual price of Apple, you'll notice that the ask price, what the sellers of Apple stock are selling Apple for, is always really close to what it's trading for. And there's just a 1 penny difference between what the buyers want to buy it for. You always want to buy things cheap, right? You want to get a sale, a discount. You don't want to pay what the seller is asking for. You want to get a little bit of a discount. But the seller, what they're asking for, they want the full price. They want as much as they can get, so they're asking for a higher amount. Well, the same will go for these options contracts. So let me hit the pause button on this, and we're going to take a closer look at the bid and ask. So let's look at one of these at the money contracts. We're 14 days until expiration, and the people who are selling these contracts, let's look at a put contract, they want to sell them for $2.34. This is kind of a misnomer because this price represents the cost per share, and if you remember, each share represents 100, or each contract represents 100 shares. So $2.34 times 100 would really be $234. So the seller of this put contract wants to collect $234, but the buyer only wants to pay $232. All right. Similarly, if we go over here to the call side, the seller of the call wants to sell it for $3.35 or $335, but the buyers only want to pay $330. So there's kind of a difference between the two. And so if you were a buyer, you would be offering to pay $330. If you're a seller, you would want those buyers to pay $335, right? So I hope that makes sense as far as the bid and ask go. But there's one thing that we do in trading, in options trading. It's pretty standard across the board. I don't know if many people talk about this though. And so I thought I'd share this with you as a little bit of a bonus for this part of the course. And that is the mid price. All right. Now, savvy buyers, savvy shoppers will always want to get a discount. Savvy shoppers will always want to get a discount. They don't want to pay a full price. And then people who are selling want to get as much money as possible. And so there's a way to do this in your broker platform, and that's called trading at the mid price. price. So let's go look at trading at the mid price here. Let me go back, sorry. Go back to our trading platform here, and I'll show you where to find that information. So let's say I want to buy a call contract, right? And I want to buy the 190 strike Apple call contract. So that means I'm willing to buy 100 shares of Apple at $190 a share. And then here's the expiration date. It's 14 days before expiration. And so I'll go over to this ask column. I can just click right on that because that's what the sellers are asking for. It's $335, $3.35, right? Times 100. And I can click on that, or if I right click with my mouse, it's going to pull up this whole menu. And so I'm just going to say that I want to buy a single contract, but I want you to look at something. The buyers only want to pay $330. The sellers want to sell them for $335, but what we do, because we're savvy shoppers, is we want to focus on this mid price here. And most broker platforms have this built in. So instead of paying full asking price for that option, what you want to always do is only offer the mid price. You want to get your options at a discount, all right? When you're buying an option, you don't want to pay full asking price. You want to get them at a discount. And so you're asking the seller to kind of come down a little in price closer to what the buyers want to pay, right? And that's a way to get your options for a little cheaper. So we always focus on the mid price. Similarly, if we were to be the seller, like I said in the previous video, we are primarily sellers of these options. We don't want to sell them at the actual price that buyers want to pay. We want to get a little bit more, right? The buyers are saying, no, we're only willing to pay $330, $3.30 per share. But we want to collect more. So what do we offer? Well, we're going to offer to sell at the mid price. So instead of $330 a share, which is what buyers are willing to pay, hey, can you just come in with a little bit more money and we'd be willing to sell that to you, right? So this kind of tells you where the buyers are, and you want to kind of ask them for a little bit more. You want to get that mid price. Similarly, when you're buying, that's where the sellers are, and you want them to come down in price. So we use the mid price, and I don't know if a lot of people talk about that, but that's a pretty common strategy amongst successful traders. So let me just go ahead and delete that. And then one thing you'll notice that before we wrap this up, I just want to point out something out to you. So let's focus on this 190 strike put option. Buyers want to pay $2.32. Sellers want to collect $2.34, right? And that's for a contract that's 2 weeks out in time, right? Look at those numbers, kind of write them down, memorize them, 232 and 234. If I were to go a little further out in time, let's say another week, well, now those same strike price, $190 a share, is got more value, right? It's amazing the difference 1 week makes. Because that week, in that week, a lot can happen in the market. And that's why this extrinsic value changes with more time, because speculators are speculating that a more favorable outcome might happen within this time frame. And the odds of that happening, we'll go into the odds of it later in this course, but the odds of that happening might be pretty good, that, you know, a favorable event will happen that will cause this outcome to happen in your favor. So that's why, you know, if we go out, instead of 1 week, we went 2 weeks, and instead of $2.32, $2.34, now they're up to $430 and $435. So time is something that adds to the value, but as time goes on, as we get closer and closer to them being expiring, that premium amount starts to go away. So as a buyer of options, you've got to be really careful about making sure that you do the right thing. Whereas as a seller of options, this kind of works in your favor. You know, if there is no favorable event. And again, more about this is talked about in our strategy courses. All right, so I think that's enough for the broker platform. Let's go back to our presentation here, and we'll wrap it up for this video. So homework, right? Most of the time we just do a wrap up, but let's do some homework. If you have a brokerage account, find out how to view the option chain in your brokerage account. You know, if you have a Tasty Trade or a Robinhood, Merrill Lynch, whatever it is, find out how to access that trading platform and look at the option chains. You know, compare it to the one I showed you in this video. Most brokerages offer trading software you can install. You can also put it on a mobile device. If that's something you're planning on doing, definitely familiarize yourself with that platform. Something else I wanted to point out, if you're watching this and you don't even have a brokerage platform yet, a lot of people get into trading without having a broker platform. You can still do this. Go to a web browser. I'll show show you here in a second, and just do an internet search for NASDAQ option chain. So I went to a web browser here. Let me share this with you. Let me make sure I pull up the right one. There we go. So I went to a Firefox browser. It opened up the Bing web search website. You can go to Google, any of them will work. Type in NASDAQ option chain, and you can go to the NASDAQ's website and look at an option chain. So if you want to practice looking at those various pieces and parts, different expirations, different ticker symbols even, it's got some of the more popular NASDAQ traded stocks here. Let's just use Apple as an example. So if I click on Apple, it'll just pull up that option chain for you. All the same components, bid and ask price. The strikes are down the middle, calls are on the left, puts are on the right. So you see the layouts the same, in the money or highlighted, out of the money or not. There's your at the money right in the middle. So spend some time familiarizing yourself with the option chain. And that's it for this part. Thank you again for watching, and I'll see you in the next part.